My name is Stephen Cox, CEO of Share Navigator. I'm a full-time options and futures trader, and I'm really excited to share with you this high probability strategy. It's a high probability strategy because you're going to be able to profit in three different ways. When a share price rises, when it goes sideways, and when it falls, so long as it doesn't fall too much. And we're going to explain why during the course of this video. Now, just a reminder, this course is particularly beneficial to residents of the UK and Ireland because of the tax-free nature of it when you apply it in a spread betting platform. If you like the content of this video, please like, share and subscribe. It really does help us to continue to provide free content on YouTube. So let's get started. So this strategy, folks, is a high probability strategy. So you're looking at a chart at the S&P 500, and you can see the current price of it is at about 6873. What we're going to do is basically ensure the value of the SP 500 to the value of 6,400, which is about 6.8% lower. And this strategy will allow us to profit if the share price rises, if it trends sideways, and even if it falls, so long as it doesn't fall as much as 6.8%. We're going to show you how now. So in order to explain the short put option strategy in the spread betting platform, we need to go back and just remind you what a traditional short put strategy is. So a short put is a single leg strategy where we're granting the buyer of the put option from us the right, but not the obligation, to sell 100 shares of an underlying asset at an agreed price before an agreed date. And in return for taking this obligation, we collect a cash premium. And this premium is the maximum amount of money we can make. In essence, we're selling insurance on shares. So that's your traditional way. There's slight differentials here when we go to the spread betting version. Let's highlight them now. So with an option spread bet, there's no assignment to shares. The profit or the loss is cash settled at expiration, or if we decide to close the trade down early. And what we do is we actually bet per point at the option price that's quoted at the time, whether the S&P 500 will remain above that strike price. And finally, it's tax-free. That's one of the main differentiators, of course, for residents of the UK and Ireland. So the best way to teach you to do this is to use a real-life example. You're looking at a quote screen with IG index. You're looking at the US 500. And you can see that the current price is at 6868. So we're going to look now at the option quotes on the US 500, which is the equivalent of the S&P 500. Now, one reason we use the S&P 500 for this type of strategy, just to remind you, we have a statistical edge. And again, we covered that in a course in the short put option strategy course. And we'd really encourage you to look at that video as well. And that we'll link it at the end of this video here. But here's a typical option quote screen with IG index. These are the December options, expire in 37 days. And we're going to focus in on the 6,400 strike. And I want you to remember our graph from the beginning. We're going to ensure the value of the SP 500, which is currently trading there at 6891 now, to the value of 6,400. So we can profit from this as long as it stays above 6,400 in the next 37 days. And you can see the sell price is 27.18. That's what we're going to bet basically. And the buy price is 28.68. Now, this is one of the main differences here. There's a big difference in the sell price and the buy price there. That's the built-in costs that IG Index are factoring in for holding on to this trade. So one of the benefits as well over traditional spread bet is there's no overnight charges. What we pay now is what we're paying up front. So we're immediately going to go into a slight loss on this depending on the size of the trade that we place. So let's get into that now. So we've clicked on the sell price and you can see we're going to put a size of 10 on that. And right down below, you will see that our margin impact is €2,977. So this is a 12K account. So that's what IG Index are setting aside to maintain this position. Now, an important note is that margin will move up or down depending on whether the trade is going for us or against us. So you don't want to use up all of your margin on one particular trade. That would be a very silly thing to do. So we're going to place the trade and then I'm going to show you what the profit and loss numbers will look like on this particular trade. So this is what our position looks like now in our spread betting account. You can see we've minus 10 of the US 500, 6,400 put. And you can see we've immediately gone into a loss situation of 1470. That's the spread I told you about at the beginning. That will go up and down now as the trade continues on. And remember, if at expiry the US 500 is above 6,400, we will make our full profit. So what is that full profit going to be? We want the option to expire worthless, and this will happen if the share price of the US 500 closes above the strike price at 6,400 in the next 37 days. Our maximum profit is the premium we receive times the bet per point. So remember, the premium was 27.19 multiplied by 10 is 271.90. Our break-even price is the strike price, which is 6,400, minus the premium received, which is 27.19, and that equals 6,372.81. In other words, the share price can fall all the way to 6,372.81, which is about 7%, and we still make a profit. And again, just to remind you why this is a high probability trade, we've sold what they call an out of the money put. That's where the strike price is below the share price. And we can profit in three ways, where the share price rises, trends sideways, or falls, so long as it doesn't fall more than about 7%. The odds are stacked in our favor here. When you normally spread bet or buy a stock, your odds are at 50% or less. These odds here, remember, are at 87%. That's why the probability is so high. We can allow the shares to fall quite a bit from here. But it's important to look at our potential losses. And our losses are our break-even price minus the share price times the size of the bet. So for example, if the share price of the S&P 500 fell to 6,300, we would lose $718. If it fell to 6,200, we could use $1,718. So that's why there is risk management required throughout the trade, and we're going to share that with you now. Now, first and foremost, just on the risk management, it's highly unlikely we will have to manage this trade. In fact, there's only about a 10% chance, right? But things happen sometimes. Now, managing the trade, we encourage people to take 50 to 80% of their max potential profit. So we know our max potential profit is about $270. So if it gets to anywhere between $150 and $200, we would take that profit off the table and walk away from the trade. If the trade starts moving against us, we can roll out the position. That means buying back this put option, closing it down, probably for a loss, but opening up the January one, probably for another credit. And we can even roll the strike price down. That's called rolling the trade. And then sometimes you just got to take the hits early. If our mindset changes, we need to just walk away and take the loss. So that's it for the short put strategy in a tax-free environment. Some key highlights. It's tax-free for residents of Ireland and the UK. It's a high probability strategy. You have a great chance of winning. And there is a management plan in place there. If the trade does start to go against you, it's important that you recognize that. And finally, please remember, in the Share Navigator website, you can access our option trading courses and our spread betting courses for free, and we would encourage you to do so. If you'd like to contact us or ask any questions, please reach out via our website in the chat area, and we'd be more than happy to help you out. Okay, thanks and bye for now.